Hey everyone, welcome back to Corporate Dakota, the place where we uncover the hidden secrets buried within those intimidating corporate filings. Today we're diving into BlackRock's latest report, and let me tell you, they've cooked up something interesting to keep their top brass motivated. We're talking about a new way to reward their most important people with some serious skin in the game. Stick around to find out how this new plan works and what it could mean for BlackRock's future and yours. If you are an investor, if you find value in our straight-to-the-point breakdowns of corporate documents, make sure you are subscribed. And while you are at it, join our Discord community linked below for even more insights. Alright, let's get straight into it. This is a Form 8K filing with the Securities and Exchange Commission. Think of it as a current report for significant events that shareholders need to know about right away. The really interesting stuff here is happening on the 13th of January 2026. The company in question is BlackRock Incorporated. You know them, the giants of asset management. They manage trillions of dollars for people and institutions all over the world. Now, before we get to the juicy details about executive compensation, let's quickly touch base on what is listed on their exchange. BlackRock's common stock trades on the New York Stock Exchange under the ticker symbol BLK. They also have some debt with 3.750% notes due in 2035. Also on the NYSE, often referred to by its ticker BLK35. BlackRock is incorporated in Delaware and has been known for quite some time in the financial world, making it a well-established and major player. So what triggered this report? It is all about a new incentive program. They're calling it the Executive Carry Program, or ECP. Essentially, the Management Development and Compensation Committee, the folks who decide on executive pay, adopted this new carry-based incentive program on the 13th of January 2026. This program is designed for selected senior executives, excluding the Chief Executive Officer. The goal here is to give these executives a piece of the action, the so-called carry distributions from a pool of BlackRock's top private markets investment funds. This is a big deal because it directly ties their rewards to the performance of these specific investment areas. The company says this move recognizes the significant growth and importance of their private markets business. By offering these performance-based rewards, they aim to align the long-term interests of their senior executives with the success of these private markets funds. The executives chosen for this program will be those whose contributions are absolutely critical to BlackRock's private market success and its long-term value creation. Every year the awards given out will depend on how well each participant has performed, led their teams, and impacted the private market's business and overall company value. BlackRock plans to start identifying participants and handing out these awards in 2026. What makes this particularly unique is that these are not guaranteed bonuses. These are pay-for-performance incentives. They are at-risk long-term performance-based payments. This means the executives get nothing up front. The potential payout only comes if the participating investment funds perform exceptionally well over an extended period. This structure not only aligns executives with fund performance and investor outcomes, but also with long-term shareholder value. The generation of carry distributions requires successful fundraising and solid investment performance, which in turn supports future fundraising and organic growth in BlackRock's investment advisory fees. On top of all that, this program is a powerful tool to attract, retain, and motivate top senior talent in a very competitive market by offering unique and valuable long-term opportunities. It is important to note that BlackRock has had carry-based incentives for employees for years. They even introduced a similar component for the CEO in 2025. However, executives who are already directly compensated based on fund-level performance through other existing carry programs will likely not be participating in this new ECP. Let's break down the key terms of this executive carry program. The awards themselves will be channeled through a special partnership vehicle. This vehicle holds the right to receive a portion of the carry distributions from the participating private markets investment funds. Importantly, these awards will not include any value the fund might have already gained before the award date. Each executive's potential future carry distributions, some if any, are entirely at risk and depend entirely on how well the participating funds ultimately perform. These distributions will only happen if the underlying funds hit specific performance targets over a long time. There might even be holdbacks to account for the final fund performance. The funds that get included in these executive awards are carefully chosen and approved by the MDCC. These selected funds will be a select group of BlackRock's private markets offerings considered flagship funds. They are expected to cover all of BlackRock's private markets asset classes such as infrastructure, private debt, private equity, and real estate. Generally, these flagship funds raise over $1 billion in capital among other criteria. Now let's talk about when they actually get paid. Each award under the ECP has a 5-year vesting schedule. This schedule starts from the date the award is allocated. Crucially, there is no vesting at all until the 3rd anniversary of the allocation date. After that, 1/3 of the award vests on each of the 3rd, 4th, and 5th anniversaries. What happens if someone leaves? Any part of the award that is not yet vested will be forfeited if an employee leaves the company for any reason. However, there are exceptions. If an employee is involuntarily terminated without cause, or if they leave due to qualified retirement, death, or disability, the rules change. In cases of involuntary termination without cause or qualified retirement, vesting continues for 2 more years from the termination or retirement date. Any unvested portion remaining after those 2 years is forfeited. If an executive passes away or becomes disabled, vesting accelerates, fully covering the entire award. All these termination protections, except for death, are contingent upon the executive adhering to strict rules. These include non-competition, non-solicitation, and non-disclosure obligations. Furthermore, any awards granted are subject to BlackRock's existing clawback and recoupment policies, meaning the company can take back compensation under certain circumstances. Some investment funds might distribute carry before all their assets are fully realized. These early distributions could be subject to a clawback depending on the fund's ultimate performance. Because of this, BlackRock reserves the right to hold back a portion of any carry distributions from these participating funds to cover potential obligations to return capital to fund investors. The full details of this executive carry program are filed as Exhibit 10.1. This summary gives you the highlights, but the actual document has all the specifics. And as always, these filings now include an interactive data file in XBRL format, which is great for analysts to crunch numbers, but for us, it is good to know it is there for transparency. Overall, this move by BlackRock signals a continued strong focus on their private markets business and a sophisticated approach to executive compensation. By making a significant portion of executive pay contingent on the long-term success of specific high-performing funds, they are creating a powerful alignment between their leadership team and shareholder interests. This strategy aims to not only incentivize current performance, but also to retain key talent in a highly competitive industry. The rigorous vesting schedules and at-risk nature of these awards mean that executives will truly have to deliver sustained results for years to come. While this is a sophisticated financial instrument, it boils down to a simple principle: reward what you want more of, and BlackRock clearly wants more success in private markets. It is a smart move that mirrors what successful venture capitalists and private equity managers have done for years, incentivizing growth and profitability through direct stake in the upside. The risks are well defined with clear clawback provisions and strict forfeiture rules, making it a robust plan. The opportunity for BlackRock is clear enhanced focus and performance from their top-tier executives in a growing and lucrative segment of the financial markets. For investors, it shows a company that is thinking strategically about long-term value creation and executive alignment, which are usually good signs. Alright, that is our deep dive into BlackRock's executive carry program. What is your take on this kind of executive compensation? Do you think it truly aligns interests, or is it just another way to reward the top brass? Drop your thoughts in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more corporate investigations. And don't forget to join our Discord community linked in the description for deeper discussions and insights. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.